Hi, welcome to our channel of IGNOU Audiobooks, Indira Gandhi National Open University, School of Management Studies, SOMS, Postgraduate Diploma in Financial Markets Practice, PGDFMP. MFP2 Equity Derivatives. Block-1 Introduction to Derivatives. Unit 3 Spot and Derivative Markets. Objectives. After studying this unit, you should be able to appreciate the role of derivative markets in equity, explain the relationship between spot price and futures price, understand the meaning and implications of contango and backwardation, and analyze the operation of arbitrage between equity and futures markets, its role and earnings potential. 3.1 Introduction. A market, in which goods, services or financial assets are traded for immediate delivery, is known as spot market. This differs from futures markets where the delivery would be made at the future date. In the context of Indian stock markets, the settlement cycle for the spot market, the time period in which delivery of financial assets sold and payments for financial assets bought, is T2, implying that the transaction would be completed 2 days after trade is done. Spot market instruments are simple financial instruments like equity, bonds and debentures. As the markets grew in volume along with increase in volatility, there was a felt need for instruments which can be used for the purpose of hedging, arbitrage, speculation and risk cover. As a result of this, derivative instruments were introduced in the Indian markets. The derivative instruments derive their price from the value of the underlying asset. The main instruments clubbed under the general term derivatives are A. Forwards, B. Futures, C. Options, D. Options on futures, A. Forward rate agreement, and F. Swaps. 3.2 Equity spot and derivatives market. Equity spot market. The spot market gives the investor an opportunity to invest in stocks of companies listed on a stock exchange at an agreed price prevailing on the exchange with immediate spot settlement, payment and delivery. In practice, spot settlement happens on day T2, which is 2 days after the trading day. Example, you can purchase stock of Reliance from the Stock Exchange, Mumbai, BSE, and the National Stock Exchange, NSE, through your broker on any trading day at prevailing prices. When you buy shares of a company in the spot market, you are commonly referred to as an investor or a shareholder. When you own a share, you are sharing in the success of the business, and you actually become a part owner of the corporation like Reliance. Equity derivative markets. A derivative is an asset whose value is derived from the value of some other asset. The other asset is generally known as the underlying, for example, a commodity like gold, financial assets like shares or equity indices. Imagine that you have signed a legal contract that, with the payment of a small upfront margin, gives you the right to buy a fixed quantity of an underlying asset like Reliance stock at a price determined now at any time in the next 3 months. Here you have not paid the full amount but a small upfront margin, and you have an obligation to buy a certain quantum of Reliance shares in the forthcoming next 3 months. Such kind of exotic contracts are called as derivatives. The above example represents a futures contract within the universe of derivatives. The segment of organized stock exchanges where trading in derivatives takes place is known as derivatives segment. In India, equity derivatives are traded within regular stock exchanges under a separate segmental framework. India does not have exclusive exchanges for equity derivatives. Rationale for derivative markets. Derivative products have been introduced in a phased manner, starting with index futures contracts in June 2000. Index options and stock options were introduced in June 2001 and July 2001, followed by stock futures in November 2001. Sectoral indices were permitted for derivatives trading in December 2002. During December 2007, SEBI permitted mini derivative F. Tenor of these contracts was 3 months. In January 2008, longer tenor index options contracts and volatility index contracts were introduced, and in April 2008, bond index was introduced. In addition to the above, during August 2008, SEBI permitted exchange traded currency derivatives. The interactions and correlations between markets that were once considered separate are today closely connected, with prices in one market significantly impacting another. Table 3.1 Phenomenon growth of futures. Look at the screen. Participants in physical markets use futures market for price discovery and price risk management. It is widely believed that, in the absence of a regulated futures market, they might speculate on unorganized markets. A trader buying shares in the spot market will be required to pay the entire amount in 2 days' time. In the futures market, the trader will be required to pay a small initial margin, say 10%, and he takes up a long position, meaning a position where he has bought, returns on the futures market will be much more attractive than the cash market as the impact of leverage, much smaller investment, will be enjoyed by the trader whose view happens to be correct. It is important to understand that if the trader's view is wrong, his losses, as a percentage of the amount invested, will also be magnified. Here is an example of an informed investor generating a substantial gain from futures market. Let us assume that the market lot on the Nifty is 50 units and that a futures position requires an initial margin payment of 20% of the notional value. Look at the screen. Figure 3.1, Futures and Spot for Reliance, expiry the 24th of September 2009. Suppose he went long on Reliance in spot and futures market on the 1st of September 09. He closed his positions on the 24th of September 09. Suppose Reliance future lot size is 100, that is, he purchased Reliance futures having 100 stocks as underlying. In the cash market his profit on 100 stocks is 2100.95 to 1980.85, 100 equals 12,010. Return on investment equals 120,101, 198085 equals 12,010, 198,085 equals 06%. In the futures market his profit on one lot is 2100.6 to 1983.4, 100 equals 11,720. Return on investment equals 117,201, 20% of 198340 equals 11,720, 39,668 equals 29.54%. Here we have assumed that no other margin other than initial margin of 20% is paid. Types of derivative markets. Derivative products are either traded on stock exchanges, exchange-traded derivatives, or bought and sold privately, over-the-counter market. Exchange-traded derivatives are those derivatives which are traded through specialized derivative exchanges, whereas over-the-counter, OTC, derivatives are those which are privately traded between two parties and involves no exchange or intermediary as a third party. Those derivatives which are traded on exchanges are standardized products, as exchanges cannot customize products to suit individual needs. Those that are bought or sold over the counter could be customized to your needs. Forwards. A forward contract is a contractual agreement made directly between two parties. One party agrees to buy a commodity or a financial asset on a date in the future at a fixed price. The other either agrees to deliver that commodity or asset at the predetermined price. In a forward contract, the two parties are taking a risk on each other, and if the counterparty does not perform, the first party may suffer a loss. In the subprime crisis that recently rocked the financial world, banks were afraid to deal with each other, as each bank ran the risk that the other bank may not be in a position to perform its part of the derivative contract. Futures. A futures contract is essentially the same as a forward, except that the deal is effected through an organized and regulated exchange. The stock exchange provides settlement guarantee. The two parties do not know each other and do not carry a risk of the other party not performing as per the contracted terms. If the counterparty does not perform, the exchange is legally required to step into the shoes of the non-performing party. Swap. A swap is an agreement made between two parties to exchange payments on regular future dates, where the payment legs are calculated on a different basis. As swaps are OTC, over-trade counter deals, there is a risk that one side or the other might default on its obligations. Options. An option gives one party the right to buy or sell an underlying asset by a certain date at a fixed price. The party buying the option has an option, meaning it is not bound to perform, while the other party selling the option has an obligation, meaning that it is bound to perform. In India, equity futures and options are standardized contracts which are traded on the 8SE and the NSE. Both these exchanges have carved out separate segments to trade. In derivatives, over-the-counter equity derivatives are not allowed by SEBI regulations. Benefits of derivative markets. Introduction of derivatives market has given a boost to the investment and trading arena. It has provided a great amount of flexibility to traders, wide choice of instruments, and most importantly, it has provided more leverage to trade not only to speculators but also to investors or hedgers who are also motivated to be an active part of the market using these instruments. Some of the benefits of derivative markets are as under. Price discovery. Due to its highly competitive nature, the futures market has become An important economic tool to determine prices based on today's and tomorrow's estimated amount of supply and demand. Futures market prices depend on a continuous flow of information from around the world and thus require a high amount of transparency. Factors such as weather, war, large fiscal deficits, elections, and political stability, investments and divestments by foreign institutional investors, all have a major effect on supply and demand and, as a result, on the present and future prices of equity, shares, commodities, and other financial assets. This regular information flow in reactions of investors and traders to such flow constantly changes the price of an underlying asset. This process is known as price discovery. As investment required to take positions in derivative markets is small, investors and traders are in a position to take such positions, or square up existing positions, very quickly in response of information flow. Such rapidity of position building would not have been possible in cash markets as availability of enough flow of funds would have become a constraint. 2. Risk management. Risk management is the process of identifying the desired level of risk, identifying the actual level of risk, and altering the latter to equal the former. This process can fall into the categories of hedging and speculation. Hedging has traditionally been defined as a strategy for reducing the risk in holding a market position, while speculation referred to taking a position in the way the markets will move. Today, hedging and speculation strategies, along with derivatives, are useful tools or techniques that enable companies to more effectively manage risk. 3. Derivatives also help reduce market transaction costs. Huge volumes in derivative markets enable service providers to keep costs low, which in turn encourages more investors and traders to take positions in derivative markets, leading to low costs and higher trading interest. As a result, hedging and speculative trading strategies are executed economically. 3.3 Spot and futures prices. Important terminologies in futures and spot markets are spot price. The spot price, spot rate of a security, scrip or index, is the price that is quoted for immediate, spot, settlement, payment and delivery on a stock exchange. Spot markets are also referred to as cash markets or equity markets. In India, cash market settlement happens on day T2 inches I. A, the second day after trading. Futures expiry. The futures price is the price agreed upon for a financial asset between two parties to buy or sell an equity share or equity index at a certain future point in time. This date is called the futures delivery date or expiry date or final settlement date. Expiry is the time and the day that a particular delivery month of a futures contract stops trading and the final settlement price for that contract month and year obtains. Future settlement price. The official price of the futures contract at the end of a day's trading session on the exchange is called the settlement price for that day of business on the exchange at a price specified today. On a day-to-day basis, the futures closing price is computed by the exchanges in India on the basis of the last 30 minutes weighted average traded price of futures contracts. On the expiry date, this closing price is the last 30 minutes weighted average traded price of underlying equity. Going long. When an investor goes long, i.e., enters a contract by agreeing to buy and receive delivery of the underlying at a set price, it means that she is trying to profit from an anticipated futures price increase. Going short. An investor who goes short, i.e., enters into a futures contract by agreeing to sell and deliver the underlying at a set price, is looking to make a profit from declining price levels. By selling high now, the contract can be repurchased in the futures at a lower price, thus generating a profit for the investor. Cost of carry. Relation between spot and futures. The relationship between the spot and futures price of an asset reflects the net cost of holding or carrying that asset relative to holding the futures. The term is derived from concept of carrying charges in commodities market. The cost of storing a physical commodity over a period of time includes storage costs, insurance and interest lost on the invested funds as well as other incidentals. It is also known as spot futures parity. Futures equals spot cost of carry. Price convergence can also be understood with respect to the cost of carry. There are various costs which are incurred in holding an underlying asset from the present date to a predetermined date, like storage, insurance and interest costs used to finance the asset. All these costs together form the cost of carry. As per the conventional formula of calculating the futures price, the cost of carry is added to the spot or cash price to get the futures price. Cost of carry can be negative or positive. If the cost of carry is substantially positive or Negative. It offers arbitrage opportunities for traders. If the cost of carry is positive, traders can sell futures and buy the underlying in the cash market to affect arbitrage. If the cost of carry is negative, traders can buy futures and sell the underlying to make riskless profit. This concept is discussed later in detail, and the purpose here is only to define the cost of carry. Figure 3.2. How futures and spot move in tandem. Look at the screen. Leverage and popularity of derivative markets. In the futures market, leverage refers to having control over large notional amounts of equity with comparatively small amounts of capital. In other words, with a relatively small amount of cash, you can enter into a futures contract that is worth much more than the notional values of your contracts. It is said that in the futures market, more than any other form of investment, price changes are highly leveraged, marrying a small change in a futures price can translate into a huge gain or loss. Thus, it is double-edged sword. Lead and lag, futures lead and spot lags. We normally see slight lead in derivative and lag in spot during the bull market. This is because of bullishness in markets and thus increase in open interest. Figure 3.3, lead in derivative and jug in spot, Reliance the 29th of November 07 expiry. Look at the screen. Figure 3.4, lead in derivative and jug in spot, Reliance the 31st of January 08 expiry. Open interest is the measurement of those participants in the futures market with outstanding trades. Open interest is the net value of all open positions in one market or contract and portrays the depth of volume that is possible in that market. A market with a low number of contracts per day but also a large open interest tells the trader that there are many participants who will enter the market only when the price is right. In India, open interest is measured and reported either in terms of number of units or number of contracts or in Rs. Cr. All these measures are equally compatible with the definition. For the purpose of understanding trends in open interest, you may use measure consistently. For market-wide open interest, Rs crows is the best measure as adding up heterogeneous contracts of various underlying would be illogical. Figure 3.5, how open interest behaved, Reliance the 31st of January 08 expiry. There might not be even a narrow spread between futures and spot prices, that is, futures and cash prices cannot deviate. Figure 3.6, look at the screen. Figure 3.6, SBI futures and spot moving in almost perfect linear correlation. Sometimes this spread is large. Figure 3.7, this can give benefit of exploiting price discrepancies. The process is known as arbitrage. Arbitrage is explained later in this chapter. The settlement of all outstanding futures contracts happens at the underlying spot price. So, though the closing prices, last 30 minutes volume weighted average price, may be different for the stocks and futures, all futures are settled at the cash price. If the futures prices are far from the cash price, arbitrage is possible. Futures prices start converging a few days before expiry. Actual convergence happens on expiry day. Arbitrage ensures this happens. Look at the screen. Figure 3.7, how open interest behaved, Reliance 31 Jan OS expiry. Convergence. As a futures contract nears expiration, the futures price and the cash price converge to eventually become the same price. The relationship between the spot and futures price of an asset reflects the net cost of holding or carrying that asset relative to holding the futures. Cost of carry denotes the interest earned on the underlying, assuming continuous compounding. F equals SEA, RT, where F equals futures price, S equals spot price, A equals 2.718 for continuous compounding, R equals cost of financing, T equals time till expiration, years. On the day when the contract expires, T will become 0. F equals SEA, RO, F equals SL, 0. F equals S, since EA, 0, equals 1. Convergence happens because of a phenomenon known as arbitrage, described in detail later. Table 3.2, basis, future, spot, calculation for Reliance futures, the 29th of November 07 expiry. Look at the screen. As shown in table 3.2, when the expiry date is approaching, basis reduces and at the day of expiry basis is 0. Let us understand in terms of the commodity markets. For example, if a physical commodity is way above the MCX futures price in sum, this will bring in arbitrageurs, speculators and hedgers who will buy the cheap MCX futures contract rather than the physical commodity. This will create demand for the futures contract, pushing the price up towards the physical. In addition, the high price of the Physical will be under pressure due to the fact that users can buy the cheaper futures. Less demand for the physical means the price comes down again, pushing the markets towards convergence or prior to expiry, a form of balance. In cash-settled contracts such as the equity indices, the price convergence between the index and the futures is automatic as there is an exchange settlement procedure, so everyone gets the same price at expiry. This further highlights the relationship and ultimate correlation between the spot market and the futures market. Basis equals futures price, cash price. Some experts define basis in a reverse manner as cash price, futures price. In this write-up, we will use the first definition, viz. Basis is futures price, cash price, LOKK at the screen. Figure 3.9, basis for Reliance Futures, the 29th of November 07 expiry. More often than not, there is a positive basis in the futures markets. The futures price usually trades at a higher price than the cash price. As time passes and delivery approaches, the cost of carry nears zero. Thus, the futures price converges to the spot price as delivery time approaches. Contango. When the futures price is above the spot price, i.e., basis is negative, the market is said to be in contango. This could happen because of negative emotion. When traders are bearish on the stock, they would prefer to short futures rather than sell equity. Because shorting futures is easier, no delivery required, and cheaper, the investment is the margin alone. In such situations, futures prices fall below equity prices and over time, they climb back towards equity prices due to convergence at expiry. Figure 3.10, contango during periods, the 5th to the 7th of September, and the 10th to the 14th of September. Backwardation, inverted market, when the price of the futures contract is trading at a lower price than the underlying spot basis is negative, the market is said to be in backwardation. This term is the opposite of contango. Backwardation happens due to various reasons, sometimes indices and scrip are in backwardation when bearish market is expected. Figure 3.11, backwardation for DLF, June expiry. Look at the screen. Figure 3.12, how basis can turn positive and negative, creating contango and backwardation. 3.4, cost of carry. Cost of carry computation. F equals SA, RT. R equals log, FS, I, T. F equals futures price. S equals spot price. A equals 2.718 for continuous compounding. T equals time till expiration, years. Cost of carry in bullish. Figure 3.13 to figure 3.16 indicate how various factors behaved in bull and bear phase on Nifty. Figure 3.13, real example of bull and bear phases on Nifty. Look at the screen. Figure 3.14, how COC behaved during bull and bear phases. In India, open interest is measured and reported either in terms of number of units or number of contracts or in Rs. CR. All these measures are equally compatible with the definition. For the purpose of understanding trends in open interest, you may use any measure consistently. For market-wide open interest, Rs crores is the best measure as adding up heterogeneous contracts of various underlying would be illogical. Figure 3.15, how open interest behaved during bull and bear phase. Figure 3.16, how no of contracts behaved during bull and bear phase. Look at the screen. Main reason of ferment movement on the Nifty during Jan 08 were commencement of still ongoing subprime mortgage crisis on global economy, soaring commodity prices. Examples of cost of carry. Table 3.3, cost of carry calculation for ACC futures, the 24th of September 09 expiry. Cost of carry equals R equals in, FS, T, 365. F equals futures price. S equals spot price. A equals 2.718 for continuous compounding. T equals time T11 expiration, years. On the 23rd of September 09. R equals in, 833.45, 833.55, 2/365, equals minus 0.022. On the 24th of September 09. R equals ln, 823.15, 823.15, 11365, equals 0, in, I, equals 0. Table 3.4, news during Aug to September 2009, overall sentiments are bearish. August 4, 2009 ACC July cement sales at 1.78 million tons, MT, versus 1.71 MT, YoY. September OI, 2009 ACC among major losers in Sensex, it touched an intraday low OFRs. 775.10, ACC among top gainers in Series X, it touched an intraday high of 836 rupees. 3.5 Arbitrage. Arbitrage is the practice of taking advantage of a state of imbalance between two or more markets, spot and futures. Mismatch can be exploited because of price difference between the market prices. Cash and carry arbitrage, overpriced futures. If the futures price is overvalued than spot price. 1. The arbitrager shorts overvalued futures. Simultaneously he is long in spot. 2. On or before expiry date, the arbitrager square off his futures and settle spot position. 3. The difference between futures prices and spot prices on the purchase and settlement date is his gain. Example, 1. The arbitrager shorted 1 lots, LU underlying shares in 1 lot, of ACC on the 2nd of May 2007, see figure, purchased 100 ACC shares. For simplification we assumed no margins or transaction taxes. 2. On the 26th of June 2007 he settled by offsetting the futures position and selling the spot. 3. The profit is calculated in Table 3.5. Table 3.5, Net Profit Calculation on ACC. Figure 3.17, Cash and Carry Arbitrage on ACC. Look at the screen. Table 3.6, Basis and Cost of Carry Calculations for ACC, expiry the 26th of June 08. Reverse cash and carry arbitrage, underpriced futures. The futures price is undervalued than spot price. Point 1. The arbitrager shorts overvalued spot, simultaneously he is long in futures. 2. On or before expiry date, the arbitrager square off his futures and settle spot position. 3. The difference between futures prices and spot prices on the purchase and settlement date is his gain. Example, I. The arbitrager was long near month DLF futures on 2 June 08, see figure, shorted 100 DLF stocks. For simplification we assumed no margins or transaction taxes. 2. On the 26th of June 08 he settled by offsetting the futures and the spot. 3. The profit calculation is given below. Table 3.7, Net Profit Calculation on DLF. Futures loss, 451, S 504.75, 100, 5295. Cash profit, 512. UTI Spread Fund, objective given in Fund Information Document. The investment objective of this scheme is to provide capital appreciation and dividend distribution through arbitrage opportunities arising out of price differences between the cash and derivative market by investing predominantly in equity, which is a relatively risk-free strategy. A normal arbitrage opportunity is described as one where the price of a particular stock in the spot market is lower than the price for the same stock in the futures market. Under these circumstances, Relay Arbitrage Fund would seek to lock in this differential by buying the stock in the spot market and simultaneously selling its futures, while this would effectively negate any equity risk. Immediately, the difference in the two prices, termed as carry, would be earned by the fund. This ensures that investors are not exposed to equity market risk, as each position in equity stock is hedged by an equal and opposite position in the relevant derivative instrument. Single quote dot. Cash settlement. For every futures contract there can be two ways of settlement. Physical settlement, the amount specified of the underlying asset of the contract is delivered by the seller of the contract to the exchange, and by the exchange to the buyers of the contract. Physical delivery is common with commodities and bonds. Cash settlement, a cash payment is made based on the underlying reference rate. Cash settled futures are those that, as a practical matter, could not be settled by delivery of the referenced item, like how one deliver an index. Even delivering the IGNOU constituents is very tough job, because one has to track, monitor the different underlying stocks. International case, CME Group. CME Group Inc. is the world's largest futures exchange. Apart from equity, it is popular for stock futures indices like DLIA, Dow Jones Industrial Average, and S. In India, stock or stock market indices are cash settled as of date. 3.6 Summary. In the chapter we learned about stock-related derivative markets in India. We understood relationship between spot price and futures price. We understood concepts of contango and backwardation using basis. We learned why return on investment in a futures market can be more than spot. We explored type of derivative markets and type of instruments in derivative markets. We explored price discovery mechanism in futures market. We explored leverage and margin in futures market. As a futures contract nears expiration, the futures price and the cash price converge to eventually become the same price. We understood the concept of various types of arbitrage. Thank you.